In this video of short-term business decisions, we're going to be specifically looking at an example of how to determine whether or not we should drop a specific product line. So in our example, we're going to look at VCR tapes versus DVD discs. So top managers of Movie Plus, they're alarmed by their operating losses. They are considering dropping the VCR tape product line. Company accountants have prepared the following analysis to help make this decision. So we can see by our income statement here, we have DVDs, we have VCRs, and our total. And we can see the DVD seems to be making an operating income of $17,000. And VCR tape seems to be incurring a loss of $33,000. And we know that total fixed costs will not change if the company stops selling VCR tapes. So the fixed costs won't change. So we need to prepare an incremental analysis to determine whether or not it's beneficial for us to drop the VCR tapes. So what we also need to remember is that, again, fixed costs are not going to change if we stop making VCR tapes. So our question really becomes, if we drop VCR tapes, will this increase our total operating income by $33,000? If that's true, then our total operating income will then be positive and will no longer be a loss. So what we need to do is, again, prepare an incremental analysis to determine if this is really going to happen. So looking at our income statement once again, we recall that fixed costs are not going to change. So that $69,000 that we have somehow allocated to VCR tapes is simply going to shift over to DVDs. If we shift that fixed cost of $69,000 over to the DVD line, we will still be incurring a loss for our business. So what we can tell ourselves here is what we'll actually be losing, since there are no avoidable fixed costs, is that $36,000 in contribution margin that the VCR tape line is contributing to the overall business. So if we look at that in an incremental analysis, we can see that we would be losing the $129,000 that the VCR tape is bringing in revenues, but we'd also be able to get rid of $93,000 in expenses. So notice how I have the reduction in revenues as a negative number. Think of losing revenues as a bad thing, so that's negative. Losing expenses is a good thing. That's why you see the $93,000 as a positive number. So the expected change in operating income would be a loss or negative of $36,000 because the loss in revenues exceeds the loss or cost savings in expenses. So we would not drop this product line. So let's continue on with this example and assume that Movie Plus can avoid $30,000 of those fixed expenses if they drop the VCR tape product line. So we need to prepare another incremental analysis to determine or show whether Movie Plus should stop selling VCR tapes. You should really already know the answer to this. We already said that we would lose $36,000 in contribution margin if we drop the VCR product line. Well, if we're able to avoid $30,000 in fixed cost, that would still leave us with a $6,000 loss to operating income if we drop the VCR tape product line. We can see that in an incremental analysis. We're still losing $129,000 in revenues if we drop the VCR tape product line, but we're also able to get rid of $93,000 in variable cost, and now we're able to get rid of $30,000 in fixed cost, giving us a loss in our operating income of $6,000. We should not drop the VCR tape product line.